Hey everyone, Calvin here. Let's talk about Bank of Canada's interest rate increase yesterday. As you probably already heard from various news, Bank of Canada has increased its interest rate by 0.5%. Right now, Bank of Canada interest rate is 1%. As you probably also remember from last month, Bank of Canada started increasing its interest rate. Back then, it was an increase of 0.25%. And within less than 2 months, it has increased its interest rate by 0.75%. Which means a huge thing, not only for general population like us, but also for business people, small businesses, big businesses. Last time it has increased its interest rate by 0.5% was back in May 2000. And that was followed by dot-com bubble burst and stock market crash. Of course, we understand that inflation has been skyrocketing since the last year due to the huge print of money, which almost tripled Canada's national debt. Most people should be surprised by how much money Canadian government had printed during the pandemic. I think printing money during pandemic in Canada has almost tripled Canada's national debt. The debt wouldn't be staying there. They will be paid by taxpayers. Expect that there will be tax increase in the future few years in Canada. Canadian people has been paying a lot of money for tax. It's funny that we're still getting into a lot more debt. So since the pandemic here back in 2020 March up to today, it's a little more than 2 years. The Bank of Canada has taken two opposite approaches. At the beginning, it was taking quantitative easing approach, aka printing a lot of money and giving free money to the general population. Right now, it's taking quantitative tightening, which is to decrease the available money on the market so that the inflation will go down. It's like you are eating sugar for 2 hours and then right after that you are started injecting insulin. It's totally opposite. You probably remember that back in 2020 people were questioning how the printing money will impact the inflations, and the experts say that the real inflation will not be impacted, and right now they're admitting that the real inflation has been skyrocketing and they want to control. I had the same question back then. I kind of believed in those experts. Right now, I started questioning them. And we don't know how this fast increase of interest rate is going to impact our economy. No one knows. Even those experts in the Bank of Canada don't know. Pessimistically speaking, it probably is going to lead us to another recession. Hopefully not. If you look at the historical rate change in the past 2 decades, you'll find that faster interest rate increase are often followed by recessions. Some of them are mild, some of them are severe. Last time we had was back in 2008, financial crisis of housing bubbles. Earlier than that, we had internet dot-com bubble. Who knows what's going to happen next? But we do know for sure that as the interest rate increases, the bond price will drop and a lot of business will bankrupt. And delinquency rate of housing market will increase. Delinquency rate is the default rate. We know that historically variable rates are good for the customers. Now stock market is expensive to buy. I know it probably is going up after this correction. And Bank of Canada also said that they are no longer keeping the Canadian government bond. This means that bond price will drop unless the bond circulating in the market will decrease too. It probably is the right time we started looking into bond market. Bank of Canada also predicted that we will reach the highest point of interest rate in June and it will start declining from July and probably will return to 2% by 2024. So this means that we probably will be able to get to a relatively good market where we can buy more stocks by 2024. And usually as the interest rate increases, stock market continue to grow, but once it's reached a certain point, it will go down. How fast it will go down depends on whether there are bubbles and how harsh the financial conditions of most of the companies are. So what does it mean for general population like us? If you are people who are looking to buy a home, especially in Canada and US, big cities like Toronto, Vancouver, I think it's not the right time to buy a home. You probably want to wait maybe another 10 months and see where the interest rate would go and where the housing market would go. As the interest rate increases, a lot of people who have taken the variable interest rates on their mortgage will pay more for their interest. Their monthly spending will rise, not only for their mortgage, but also for their daily spendings, such as on groceries, oil, gas, because inflation keeps growing. Unless we control inflation, our spending wouldn't stop growing. So I'm kind of expecting lower housing price in upcoming 10 to 24 months. Again, the reason I'm talking about this is because I think it's a core part of individual success. This is a personal finance education part, and I think it's very important for individuals in order to be successful. Interest rate increase generally means that the businesses have to pay more money for their bank loans. Their cost of borrowing is increasing. So those businesses operating on a huge amount of debt are likely going to bankrupt. If you're thinking about stocks, picking individual stocks by yourselves, you probably want to avoid those businesses have huge amount of debt. Instead, you probably want to stick to financially strong businesses. Probably want to look at their current ratio. I think more than 2 is better. For those who are looking into bond market, you don't have to buy the bond yourself. You can buy those funds and ETF that are closely replicating bond performances, other indexes. For example, if you're in Canada and if you don't want to buy Canadian bonds directly, instead if you want to treat the ETFs and funds, then you can consider such as XGB, which is to replicate Canadian government bonds performances. It's a pool of bonds, including provincial government bonds and federal government's bonds. And if you're in Canada and wants to buy US Treasury bills, then you can consider buying ETF and funds that's closely replicating US Treasury bill performances, such as GOVT, which is traded on Toronto Stock Exchange. So you can, if you're using Wealthsimple, you can use that to buy it. Of course, you can buy bonds and get the interest treated, but if you're not familiar, it's probably a little bit learning curve. I guess that's it for today. I hope you learned something interesting, and hopefully you like it. This Friday is a Family Friday, and our long weekend is coming, and I wish you a wonderful long weekend for you and your family. And don't forget to click the like button below and smash the subscribe button. Thank you very much. Thank you for watching.